Markets go up, markets go down. Traders panic in both directions. Today isn't about one chart. It's about 5 timeless truths that will keep your capital intact and your sanity marginally functioning. Sometimes price goes up, but the RSI doesn't follow. Traders cheer. They say the trend is strong. But that's like watching someone with a gammy leg run a race and betting on them to win. When momentum diverges, trust that tension. It's not always a reversal, but it's never nothing. Confirmation matters, otherwise, you're just clapping shadows. Trading without confirmation is like brushing your teeth with a hairbrush. It looks like you're doing something important, but really, all you're doing is ruining the bristles and wondering why your breath still smells like fear. Risk appetite isn't rational. It swings from FOMO to fear with no memory in between. And when analysts say risk love is back, what they really mean is everybody's drunk enough to start texting their ex. You don't trade sentiment, you fade it. If everybody's suddenly bullish just after being incredibly terrified, that's not a trend, it's a hangover. If everybody's in, then who's left to buy? When the market's up and every fund manager's already long, that's not a sign of strength. It's a setup. Because when everyone's already in the boat and the boat starts to leak, then there's nobody left on shore to rescue you, which is why you might want to consider burning those boats. If positioning is maxed out, then that edge is gone. Being late to a bear market rally is like trying to jump on a seesaw when everybody else is already on one end. You don't balance things out, you arrive at perfectly the wrong moment to get flown into the wood chips. The stock market can look calm, but when bond volatility is rising, that calm is a lie. It's like living next door to a neighbor who starts digging holes at 3 a.m. It's probably not a herb garden. Always check volatility where it hides. If bonds are whispering, then stocks scream later. If one is unstable, the other is pretending. Ignoring bond volatility is like ignoring a toddler in the kitchen who's gone very, very quiet. Whatever happens next is your own responsibility. Reclaiming key levels can feel exciting, but often the market is just testing your attention span before punishing your conviction. Patience is a position and silence is a strategy. You don't need to catch every single move. You need to survive long enough to catch the right one. Sometimes you might want to sit out the noise and wait for some clarity. Trade when the market is speaking in full sentences, not when it's speaking in static. FOMO trading is like listening to a radio in a foreign language and pretending you understand. You nod, you smile, and then you accidentally agree to swap your house for a gota and a sandwich. So what did we learn? Momentum needs confirmation. The risk sentiment, that's confidence in a costume. If everybody's in, the exit could get jammed. The volatility we see, it's like mold. If you take your eye off it, it starts to grow. And patience isn't passive, it's protective. And if you only remember one thing, trading is often waiting, watching, and surviving.